Invest $100,000 for 30 years. Low fees get you nearly $574,000. High fees leave you with only $432,000. That $142,000 loss isn't the principal you spent. It's the compounding effect of fees eating your returns, year after year. The expense ratio listed on your statement covers portfolio management and legal costs. However, hidden trading costs and bid-ask spreads exist beyond the advertised number, adding up to a full percentage point or more in total fees you actually pay. Then you have account maintenance fees and revenue sharing rebates that create a conflict where your bank keeps a cut every time money moves. You might not even see these on a simple monthly bill, but they sit there eating away at your principal like background radiation. Don't forget, cash drag from holding idle assets inside your account. These funds may charge fees ranging between 2% and 5% that act like a parking brake on your compounding engine while you wait to buy a house. So when you look at that gap between a high-fee mutual fund and a zero-fee index fund, the difference isn't just math. It's whether your savings can actually support a comfortable retirement. Every percentage point in fees means decades less growth for you. You aren't just paying the fund manager, your plan is bleeding out at the bank level too. A flat administrative charge of 0.5% on your 40K doesn't sound scary until you realize that money vanishes before it even starts compounding. That 0.5% looks like pocket change in your current paycheck, but over 30 years it snowballs into a hit to your nest egg that feels like a whole year's worth of salary disappearing silently. This is distinct from the expense ratios you checked last week. This is a separate administrative leak that sits on top of your visible investment costs without any disclosure. Don't let the paperwork in your online dashboard convince you that your contributions are safe just because they go into automatic payroll deposits. You don't have to pay for the salesperson standing in the background switch directly to zero-fee options like Fidelity's Zero Total Market Index Fund. That fund carries a literal 0% expense ratio, meaning every dollar you contribute goes entirely to work without anyone taking a slice off the top. If your broker doesn't offer that, look for Schwab's Total Market Indexes, which also list 0% expense ratios and require nothing but the $1 you have right now. You are effectively stopping the administrative leak immediately by swapping out those loaded, high-cost share classes for these passive trackers. Stop letting hidden rebalancing costs or bid-ask spreads erode your gains. Pick the specific fund with the lowest advertised fee that matches your benchmark. The math is simple. If you find an index fund with no load and minimal trading drag, you keep the compound growth that high-cost funds are currently stealing from your future. Execute this swap on every account before you retire. There is no reason to accept 1% fees when the market gives you access to tools costing almost nothing. Once you remove these drag-inducing elements from your portfolio, the money that was slowly leaking out stays in the market where it actually belongs. Thanks for watching. If you found this breakdown helpful, hit that like button, subscribe for more, and let me know down below what I should take a look at next. As always, this is for educational and entertainment purposes only and is not financial advice.